Source code speaking. John OG, oil just printed its biggest weekly surge since 1983. Nearly $900 billion erased from equities in a single session. A lot landed today, and every piece connects to the next. One thing first, watch this fully. Every segment builds on the last, and you never know which piece will matter for you later. People come back asking, John OG, where did you mention that? The answer is always the same. It was in the video. 10 minutes. Stay in it. Drop John OG in the comments if you're paying attention. Let's get into it. Markets just closed for the weekend, and before we even touch the numbers, I want you to think about something important. Major war-related developments have a habit of landing when markets are closed. Weekends, when retail cannot react and liquidity is thin. That pattern is observable, not theoretical. Ground troop discussions are reportedly happening privately. The Strait of Hormuz is effectively closed to vessels linked to the US or Israel. Iran launched another wave of missiles. The IRGC is openly challenging the US Navy to escort tankers through. And Monday morning, markets reopen into that entire situation. Keep that frame in mind as we walk through everything else. Let's start with oil, because that story has now moved beyond something you can ignore. WTI crude just posted its largest weekly gain on record going back to 1983, 34.5% in 1 week. On Friday alone, it touched $91.50, up roughly 66% since December. At the same time, the U.S. Treasury announced a $20 billion reinsurance program through the Development Finance Corporation to cover tankers moving through the strait. Oil, LNG, jet fuel, fertilizer, the entire chain. The fact that a $20 billion insurance backstop was required simply to move cargo tells you everything about how serious the disruption already is. Roughly 20% of global oil supply is currently offline. The next tape level I'm watching on WTI is the September 28, 2023 high at 95. Mark that on your chart. The tape is showing that level as the immediate magnet. We're sitting around $91.50, about $4 away. If it clears $95 with conviction while the strait remains closed, the $100 discussion opens automatically, not as a target, as a consequence. Trump's response to rising gasoline prices captured the tone perfectly. If they rise, they rise. That is not a soft landing message. That is war economy language. There's also a detail inside the oil story getting almost no coverage. U.S. Treasury Secretary Bessent suggested the United States may consider lifting sanctions on Russian crude oil. Read that again carefully. In the middle of a conflict pushing oil toward $100, the administration is floating the idea of bringing Russian supply back into the market. That can mean two things. Either it's a pressure valve designed to cap prices before they become politically unmanageable, or it signals a much larger geopolitical realignment moving faster than most analysts realize. Either way, it does not happen in isolation. Watch it. At the same time, the largest U.S. defense contractors have reportedly agreed to quadruple production of what Trump called exquisite class weaponry. High-precision systems, increased volume, expanded output. The U.S. government also stated it has virtually unlimited supplies of medium and upper medium grade munitions ready for deployment. That language is not about de-escalation, that is mobilization language. When defense production quadruples while the largest bombing campaign of the conflict is announced in the same window, the range of outcomes for the coming week expands dramatically in both directions. Now the humanitarian angle matters here too, because it feeds directly into the macro story. Right now, 99% of ships are not transiting the Strait of Hormuz. The Middle East depends heavily on imported food and desalinated water infrastructure that requires stable shipping lanes. If this disruption stretches from days into weeks, the region faces a real risk of food and water shortages. That is not speculation, that is simple supply math. An oil shock layered on top of a regional food crisis and an active bombing campaign does not resolve quietly. Now let's run the inflation numbers. Every $10 increase in oil historically adds roughly 20 basis points of inflation pressure. Oil moved from the mid-50s to about $91. That already injects more than a full percentage point of additional inflation into the pipeline. Combine that with a labor market already showing stagflation signals, and the Federal Reserve is effectively locked in a room with no clean exits. You cannot rate cut your way out of a supply shock caused by military conflict. Now equities. Over $900 billion in market capitalization vanished from U.S. equities on Friday alone. The S&P 500, Nasdaq, Dow, and DAX all closed lower. Bitcoin fell below $68,000. But here is the detail worth paying attention to. The S&P 500's trading range across the first 41 trading days of 2026 was the narrowest on record going back to 1928. Even the Dow Jones ranges dating to 1896 were wider. The compression has been historically extreme. During the 2008 financial crisis, market ranges expanded roughly 1,200% wider. During the pandemic crash, around 450% wider. Compressed systems behave like springs. The longer the compression lasts, the more violent the release tends to be. Suppressed systems rarely resolve quietly, they break. Now let's talk about silver, because the physical market is sending a signal the paper market still hasn't fully priced in. Total COMEX silver inventory dropped to 349 million ounces in the latest update. Another 2.2 million ounces drained in a single session. Breakdown: 305,000 ounces withdrawn from Brinks, 611,000 from CNT, 1.278 million from MTB. Just under 500,000 ounces adjusted into Loomis registered. Multiple vaults draining simultaneously. Over the last 30 days, more than 51 million ounces have left COMEX vaults. That's roughly a 12.9% decline in a single month. Registered silver, the metal actually available to settle futures contracts, now sits near 81 million ounces, while the leverage ratio in futures markets is approaching 7 to 1. Physical metal is leaving, paper contracts remain. That gap is the metric to watch. The mechanism here is simple. If the paper price does not rise fast enough to ration supply, the physical drain continues. Eligible inventory, silver stored in COMEX vaults, but not available to settle contracts, dropped another 2.7 million ounces in the same session. That metal is leaving the system entirely. At a 7 to 1 leverage ratio, every ounce of deliverable silver supports roughly 7 ounces worth of futures contracts. That equation resolves in only two ways. Either metal flows back into the vaults, or the price moves sharply higher to ration access. There is no third option. Now layer the China dimension into that. U.S. intelligence sources are suggesting China may be preparing to provide financial assistance, spare parts, and missile components to Iran. Regardless of your geopolitical interpretation, the market effect is the same. It implies no quick resolution, no rapid reopening of the strait, and no immediate normalization of tanker routes. At the same time, China has already begun implementing export controls on silver-related materials, two separate narratives converging on the same physical supply constraint. Western silver spot closed around $84.60, rejecting the $85 level multiple times during the session. Meanwhile, Shanghai spot is trading near $96, representing roughly a $12 premium. The frustrating part of today's tape, and honesty matters here, is that the US dollar weakened and silver still failed to close above $85. Gold showed stronger relative momentum, finishing around $5,170. The technical levels we discussed earlier, $5,880, then $5,200, remain in play. That path is still intact. Now the bear case, because it exists and ignoring it is not analysis. COMEX leverage means a paper-driven sell-off can push spot prices lower in the short term even when physical supply is tight. War headlines can reverse direction instantly. Even a rumor of negotiation can trigger algorithmic selling across metals in minutes. The dollar's direction is also unresolved. A sudden DXY reversal would apply technical pressure. And after the 22% margin reduction on COMEX silver announced earlier, it is now just as inexpensive to hold a paper short position as it is to hold a long. None of those factors change the structural supply situation underneath, but they can absolutely delay the tape. Anyone positioning in this environment needs to understand that clearly. Connect the dots, and here is where we land. The oil situation is not resolved. It may not be resolved before Monday's open. Insurance programs and bombing campaigns are not substitutes for a ceasefire. Watch developments between now and Sunday night. If the Strait of Hormuz remains effectively closed, $100 WTI stops sounding dramatic and starts sounding mathematical. That feeds directly into an inflation problem the Federal Reserve cannot control. The Russian crude unsanctioning discussion is worth monitoring closely. It could be a pressure valve, or a signal of something far larger shifting behind the scenes. Silver closed below $85 despite a weaker dollar. That leaves a key question heading into next week. Either the dollar relationship reasserts and silver breaks above $85 with conviction, or something else inside the market structure is interfering with the tape. That is the open question going into Monday. Invest with logic, not hype. John O.G. out and about.